When people hear my name, they usually expect me to speak only about old things. They expect railroads, insurance, candy, soda, furniture, banks, newspapers, and the sort of businesses that look so ordinary most people walk past them without noticing how much money they can make over long periods of time. That expectation is understandable. I built my life by preferring durable economics over glamorous stories. But if you stay alive in markets long enough, you learn something important. The outer costume of wealth changes, the inner logic does not, the names change, the hardware changes, the headlines change, the industries that dominate one decade can feel almost irrelevant to the next. Yet the same question keeps paying, where is the toll road? Where is the choke point? Where is the layer of the system that everybody must pay for if they want to participate in the next wave? That is still the game. It was the game when America was laying rail. It was the game when branded consumer products conquered distribution. It was the game when insurance discovered float. And it is the game again. Now, only this time the railroad is data. The bottleneck is power, networking, manufacturing complexity, and compute density. The value is not merely in owning a clever app or a fashionable promise about the future. The real value is often sitting lower in the stack, where the spend becomes unavoidable. That is what interests me as I look toward 2026. A great many people think artificial intelligence is a software story. It is not merely a software story. It is an industrial build-out that matters because industrial build-outs create a different class of winners. When a cycle becomes physical, capital-intensive, infrastructure-heavy, and system-dependent. The best businesses are often not the ones giving the prettiest demos. They are the businesses selling the picks, shovels, copper, power, switches, racks, etch tools, memory enablement, and long-lived operating systems that allow the whole machine to function. That is where I would rather sit. I have always preferred being paid for necessity rather than excitement. Excitement is an unstable revenue source. Necessity is a wonderful one. If I had to assemble a focused group of businesses for 2026 around the modern build-out, I would keep coming back to the same names: Arista Networks, Applied Digital, AeroVironment, IonQ, NVIDIA, Lam Research, Amazon, AMD. Now, I do not say that because I believe every one of them should be bought blindly at any price. That would be a childish conclusion. A great business can still be a poor investment at the wrong valuation. I have said for years that a wonderful company is not automatically a wonderful stock if the market has already done all the admiring in advance. So what I want to do is not hand out a shopping list in the style of a man selling lottery tickets. I want to explain how I think about the economics of this whole cluster. Because once you understand the cluster, the names become easier to rank. The first thing to understand is that AI spending is now happening in layers. There is compute, there is networking, there is memory, there is power, there is cooling, there is manufacturing, there is software orchestration, there is cloud delivery, there is inference, there is defense autonomy, there is early stage quantum optionality. If you only look at the most visible layer, you miss half the money. That is exactly the sort of mistake the public always makes. The public loves the star player and ignores the offensive line. Then it is surprised when the offensive line quietly becomes one of the best economic assets on the field. So let me start with Arista Networks. Because to me, Arista is one of the clearest examples of a business living in the hidden but essential layer. People see AI and they think of the chip. Fair enough. The chip is glamorous, the chip is the engine, the chip is easy to photograph, easy to narrate, easy to point to, but a cluster of GPUs is not useful, merely because a bunch of expensive metal is sitting in a room. Those clusters must move data, coordinate workloads, communicate at speed, and operate with very low tolerance for delay. That is where Arista lives, and that is why I like it. When the compute becomes more valuable, the networking layer becomes more economically critical, not less. That is a beautiful position. Arista's numbers reflect that position very clearly. Revenue expanded from roughly $2.3 billion in 2020 to around $8.5 billion in 2025. almost a four-fold increase in 5 years. Net margins moved from about 27% to more than 42%, which tells you the company is not merely selling more units. It is gaining operating leverage while doing so. Free cash flow margins exceeded 50%. Capital expenditure remained tiny relative to revenue, and the business accumulated roughly $9.5 billion of cash and investments against almost no meaningful debt. That combination is exceptional in infrastructure. High growth, very high profitability, fortress cash, and very low capital intensity are not traits that often travel together. Fe Philocite Fe Turn 96 File 0 Fe. What matters even more than the historical numbers is the strategic direction. As AI clusters scale, networking becomes a bottleneck. Once networking becomes a bottleneck, the switching and software layers stop being secondary purchases and start becoming mission-critical purchases. That gives Arista pricing, relevance, entrenchment, and a growing reason to be part of the long-term hyperscaler refresh cycle. To me, the key variable is whether revenue growth can stay around the mid-20% range, because if it does, it tells me that the hyperscaler CapEx cycle remains alive and Arista remains embedded at the right place in the stack. Fe Philocite Fe Turn 96 File 0 Fe, the second name, is Applied Digital. Now this one is riskier, which means it should not be treated the same way as a more mature business like Arista or even Amazon. But risk and opportunity often live in neighboring houses, and Applied Digital is trying to build its house in a very good neighborhood. The market still underestimates just how much AI is becoming a power story. A lot of people still talk about data centers as if they were just real estate with some servers inside. They are not. The valuable thing is not the building by itself. It is access to cheap, long-duration, reliable power in a world where compute demand is beginning to outrun ideal supply conditions. That is what Applied Digital is trying to secure. It is building large-scale AI data centers around low-cost electricity, especially in places like North Dakota, then locking in. Term economics before scarcity makes those economics impossible to replicate cheaply. That is good thinking. It is the kind of thinking I have always admired. Buy or control the constraint. That is usually where the money is. The financial picture here looks explosive, but you have to read it correctly. Revenue went from only about $8.5 million in fiscal 2022 to roughly $215 million in fiscal 2025, with a more recent run rate around $257 million. That sort of growth can make investors silly if they stop there. The more important point is that the first major AI facility was not even fully contributing while the company was already putting up strong top-line gains. And the Ellendale campus is expected to add meaningful quarterly revenue as additional buildings ramp through 2026 and 2027. Gross margins look compressed now because build-out costs are dominating the early stage, but management's mature target is around 45% or better once facilities are fully leased and operating. The metric that matters most is deployed megawatts, because every 100 megawatts placed into service can translate into roughly $200 million in annualized revenue at attractive incremental margins if execution holds. Fe Philocite Fe Turn 96 File 0 Fe. This is not the kind of business I would make the whole portfolio around. It is the kind of business I would size carefully as a higher upside infrastructure play. Because if the company executes, the market may discover that the real scarcity in the AI cycle was not only chips, it was power-rich capacity. The third name is AeroVironment, and here we move from digital infrastructure to a different kind of infrastructure entirely. Military doctrine for years, people treated drones and autonomy as though they were merely interesting edge technologies. That stage is ending. Modern defense is increasingly about low-cost precision, autonomy counter, drone capability, and systems that can respond faster than traditional procurement logic once allowed. AeroVironment sits at that intersection. It began as a more niche drone supplier. It is becoming a broader defense technology platform that matters. A lot of the recent financial jump came from the Blue Halo acquisition, which makes the reported numbers look messy. Quarterly revenue that had been around $170 million to $190 million stepped to $275 million and then above $450 million after the transaction. The same deal brought in lasers, space systems, and counter-UAS capabilities. Gross margins fell from the low 40% range into the high teens because the mix changed and amortization surged. That is exactly the kind of financial ugliness that can hide strategic strengthening. Backlog rose from roughly $400 million to more than $750 million. Total bookings moved above $1 billion. And the business now has longer military visibility than a simple episodic drone vendor would. The key metric for me is gross margin recovery. If margins rebuild toward the mid-20s as integration settles, then the market will have to recognize that the acquisition created a broader platform rather than just a fatter revenue line. Filocyte, Turn 96, File Zero defense companies can be tricky because they live partly inside government timing, and government timing is not always rational. Still, the world is not moving away from autonomy and layered defense systems, it is moving toward them. That makes AeroVironment worth watching very closely, especially if volatility gives a more attractive entry. The fourth name is IonQ, and here I have to be careful because quantum computing attracts a dangerous amount of fantasy. I do not want fantasy. I want evidence. The good news is that evidence seems to be arriving, at least in early form. IonQ looks like a business trying to move from scientific promise to commercial platform. That is a fragile transition, but an important one. If it succeeds, the stock can be extraordinary. If it fails, the market will punish it mercilessly. That is why this name belongs in the optionality bucket rather than the foundational bucket. Still, the recent numbers are not trivial. Quarterly revenue jumped from the low teens of millions to nearly $40 million in one quarter, effectively compressing almost all of 2024 revenue into a single period. Gross margins remain below 10% because the company has been willing to place systems at near cost in order to get embedded with governments and enterprises. That is a dangerous strategy if there is no later recurring value, but potentially powerful. If access, usage, and services become the higher margin future layer, the more important technical feature cited in the document is 2. Qubit gate fidelity around 99.99%, which matters because it improves the path toward practical error correction and useful workloads. The stock already ran from around $8 to the mid-$80s and then pulled back about 40% into the $50 range, which to me looks less like a broken story and more like a violent repricing that needed digestion. The one metric that matters most is revenue trajectory, continued step-ups. Would confirm that the company is not just a laboratory curiosity, it is becoming an operating business. Filocyte, Turn 96. File 1 I would never size IonQ as though it were Coca-Cola. That would be insane. But I am perfectly willing to own a smaller piece of a frontier business if the asymmetry is real and the evidence continues to strengthen. The fifth business is NVIDIA. With NVIDIA, the public is no longer confused about relevance. The confusion is now about durability. Has the story peaked? Is the cycle already overround? Can demand continue? Those are fair questions. My own answer is that people still underestimate the breadth of the cycle. NVIDIA is not merely selling chips into one temporary excitement. It is selling a platform into a global compute transition. That is a different thing. Data center revenue reached roughly $51 billion in the reported quarter, up about 66% year over year, and around 90% of the company's total revenue now comes from that segment. Blackquill is not simply faster hardware. It is a systems-level improvement that delivers far better inference economics, stronger training performance, and significantly lower token costs. Those economics matter because the next stage of AI is not just building models. It is operating them at scale and making them cheap enough to deploy widely. On top of that, Nevada IDEA AI Enterprise is running at a multi-billion-dollar annual pace with triple-digit growth, which means the company is reinforcing the hardware position with software economics. The most important metric remains data center revenue growth. As long as that remains strong, It tells me that NVIDIA's role has not moved to the edge of the story. It remains at the center of the compute transition, Fei file site Fei turn, 96 file 1 Fei. What I like most is that the demand drivers now come from multiple directions. Training, post-training, inference. The world is not merely buying experimentation any longer. It is buying infrastructure. Infrastructure lasts longer than fashion. That is a good thing when you own the seller. The sixth company is Lam Research. If NVIDIA is the glamorous layer, Lam is the manufacturing spine. And I have always loved manufacturing spines because they sit in the part of the value chain where complexity becomes a source of bargaining power. The harder something is to make, the more valuable the essential tool supplier often becomes. Lam fits that pattern. It sells etch and deposition tools, which are not the kind of products the public daydreams about, but they are absolutely central to advanced logic and memory production. Revenue grew from roughly $1.6 billion in fiscal 2006 to about $18.4 billion in fiscal 2025, around 11 times larger and roughly double the broader semiconductor market's growth over that long span. That suggests structural gain, not just a cyclical tag-along. What I like even more is how the profitability evolved. Gross margins remained stable, while operating margins expanded into the low 30s and net margins approached 29%, showing real operating leverage. Free cash flow reached about $5.7 billion, or around a 31% free cash flow margin, and the company returned about 80% of that cash to shareholders through buybacks and dividends. The current demand driver highlighted in the document is high bandwidth memory. Each HBM stack requires materially more etch steps per wafer, which increases Lam's content per chip. That means the AI boom benefits Lam not only because more chips are made, but because the chips themselves are becoming more tool intensive. The metric I care about most is operating margin. As long as margins expand faster than revenue in the upcycle, it confirms Lam is monetizing complexity rather than merely riding volume. Fei site Fei turn 96 file 2 Fei. That is precisely the kind of business I like to own in a capital cycle. It is not simply getting dragged upward by demand. It is becoming more indispensable as the product set gets harder to produce. That is better than plain cyclicality. The seventh name is Amazon. Now this one is psychologically interesting because Amazon often behaves in the market the way some great businesses behave after they become familiar. They stop looking exciting right before they become attractive. Again, the crowd prefers things that are rising visibly and immediately. It gets bored with businesses that spend years consolidating while the economics quietly improve underneath. That boredom can be a gift. Amazon has a habit of moving in bursts and then spending long stretches letting the business catch up. Since around 2023, the stock has gone mostly sideways to mildly higher, while the S&P 500 has done much better. Yet the business underneath has improved sharply. AWS growth is re-accelerating toward the 20% area. Operating income surged from around $12 billion in 2022 to roughly $69 billion in 2024. Free cash flow moved from negative territory to more than $30 billion. What I find particularly encouraging is that the current round of data center investment is increasingly being funded by profits rather than by balance sheet strain. In other words, Amazon is now investing from strength. That is a different Amazon from the one many investors still imagine from earlier eras. The document emphasizes return as data center capacity fills, but the larger pattern is that Amazon has already rebuilt margins, restored cash flow, and reignited AWS while the stock has spent years consolidating. I have often made money in exactly that sort of setup. Fei file site Fei turn 96. File 1 Fei. Amazon is not a pure AI story. That is one reason I like it. If the AI cycle pauses, you still own a global commerce machine, a cloud platform, and one of the great operating companies of the modern era. It gives me a different type of exposure from the pure picks and shovels names. The eighth business is AMD. This one I find especially interesting because the market still seems unsure whether to treat AMD like a second Tier beneficiary, or like a fully established core winner, when the market is unsure and the business keeps improving, opportunity can emerge. AMD grew revenue from around $10 billion in 2020 to approximately $34 billion in 2025. So this is no longer a quirky turnaround story. It is a large diversified semiconductor company. The stock trades at roughly 28 to 30 times forward earnings. But when paired with expected growth, the document points to a PEG ratio around 0.47, implying that the market is discounting persistence more than the current business momentum justifies. Data center revenue grew more than 60% year over year and has become the company's most important profit engine. Free cash flow rose sharply to around $2.4 billion. Reported earnings are still clouded by about $3 billion a year of non-cash amortization from the Xilinx acquisition, which means the cash economics may be better than a quick glance at GAAP EA. Numbers suggest, strategically, the move from selling chips toward rack-scale AI systems matters because it increases revenue per deployment and broadens the company's role with customers. Since 2023, the stock has mostly gone sideways while the revenue, cash flow, and strategic position improved. I pay close attention to mismatches like that. Faithful Esite Fay turn 96 file 1 Fay. Now once I look at all 8 names together, I do not see 8 separate stories. I see one integrated map. Arista is the networking fabric. Applied Digital is the power-constrained capacity layer. AeroVironment is the autonomy and defense systems branch. IonQ is the frontier optionality. NVIDIA is the compute platform. Lam is the manufacturing tool spine. Amazon is the hyperscaler monetization engine. AMD is the alternative compute and systems beneficiary, that is the map. And once you see the map, the biggest danger becomes obvious. You cannot own them all at the same weight and call that prudence. That would be theatrical diversification. This basket is thematically connected. A lot of the businesses will win or lose together, depending on the CapEx environment, the rates environment, the pace of AI monetization, and the willingness of customers to keep spending aggressively. So real portfolio construction matters. For me, if I were ranking them by a mix of durability and strategic centrality, Nevada, IDEA, and Arista would sit near the very top. Lam would be close behind. Amazon would sit high too because it gives me a powerful business with AI tailwind, but not total dependency on that one narrative. AMD would come next because of the valuation mismatch and improving economics. Then AeroVironment as a defense and autonomy platform with more execution risk but real strategic tailwind. Applied Digital and IonQ would be sized more modestly because the upside is substantial, but the execution path is narrower and the margin for disappointment is smaller. That is how I would think about sizing. Not all conviction is equal. The crowd hates that idea because it wants every favorite to be equally beloved. The market does not reward equal affection. It rewards ranking. Another thing worth saying is that I do not need all 8 to work at once for this whole framework to be useful. If 1 or 2 disappoint, the rest may still do extremely well if the broad cycle continues. That is one reason the ecosystem view is valuable. I am not betting on one obscure app becoming the next consumer darling. I am betting that the world will continue spending enormous sums to build the underlying digital industrial base. And that base touches networking, compute, manufacturing, cloud, power, rich capacity, and autonomous systems. That is a much more robust bet. I also want to address valuation because a mature investor should never ignore it. There are parts of this cluster that are not cheap in the ordinary sense. NVIDIA is not cheap. Arista is not cheap if you compare it to sleepy industrials. These are businesses the market already admires. So why own them? Because sometimes cheapness is not the main bargain. Sometimes the bargain is paying a full but sensible price for a business whose economics are still strengthening faster than the market's current imagination. That is a different form of mispricing. The market often underestimates duration. It sees a hot cycle and assumes the growth must soon collapse. If the cycle is actually a long infrastructure build-out, then a business can keep earning into that demand for much longer than the bears comfortably assume. That is where great returns can still come from even after a stock already had a very visible run. This is particularly relevant for Nvidia, Arista, and Lam. People keep looking for the point when the music stops. Maybe the better question is whether this is not a song at all, but a construction project. Construction projects take longer. That matters. Amazon and AMD interest me partly because the market's enthusiasm there has been more uneven. Uneven enthusiasm is useful. Amazon spent years going nowhere while business quality improved dramatically. AMD went sideways while the data center business became much more meaningful and the valuation compressed. Those are the kinds of mismatches I enjoy because the public gets bored precisely when the operating picture becomes stronger. The public has a short attention span. A great business can use that against it. Applied Digital and IonQ require more humility. Humility is not the same as avoidance. It simply means admitting that the range of outcomes is wider. I am willing to own wider outcome businesses if the asymmetry is real and the position size respects the uncertainty. I have never believed that risk is something you eliminate. I believe it is something you price size. And understand there's one more broad principle I want to emphasize because it matters to how I think about all growth investing. I do not need to be right about every future application of AI to make money here. That is a tremendous advantage. I do not need to know which chatbot becomes dominant, which enterprise workflow tool wins, which startup goes public, or which consumer interface becomes iconic. I need only to be broadly right that the world will keep paying for more compute, more networking, more manufacturing complexity, more cloud capacity, more advanced systems, and more enabling infrastructure. That is a much easier proposition to underwrite. I have always preferred easier propositions, not because I am lazy, because easy things can still be very profitable if they sit in the right place. That is one reason I became rich. I never believed I had to prove intelligence by choosing the hardest possible path. I wanted the profitable path. Sometimes the profitable path is simply lower in the stack. If I had to summarize this whole selection in one sentence, I would say this. I am not buying the science fiction story. I am buying the industrial revolution underneath the science fiction story. That is a much better business. Now, would I buy every one of these at any moment? Number, I would still want discipline. Some names have run hard, some deserve patience for a better entry, some belong in watch lists waiting for temporary weakness. The document itself notes that AeroVironment had jumped sharply during the writing process and might be better on a future dip. And that same general principle applies to several of these names. Admiring a business does not require buying it blindly into momentum. I can admire and wait. That is one of the great freedoms in investing. Site Fay turn 96 file 0 Fay, but if you asked me what I want to own through the next stretch of the market, I would want the businesses that everybody else must pay if this AI, cloud, autonomy, and data center build-out keeps going. Those are the toll roads, those are the choke points, those are the businesses that can keep winning even if the headlines shift from awe to worry and back again. And when I look across this list, that is what I see. Not 8 random tickers, a coordinated bet on the indispensable layers of a new industrial age. That is the sort of bet I have always liked. Because while the world argues about which app will matter most, the quiet money is often being made by the companies selling the rails, the pipes, the power, the tools, and the systems without which none of the rest can happen. That is where I would rather sit. That is where I think the best money still is.